Good morning, traders. This is Joanne with Succeed in Forex. Welcome to our Forex market news broadcast for Friday, February the 1st, 2008. We'll jump right into the headlines out of Switzerland this morning. They read, pairs trade in tight ranges before payrolls, and the Canadian dollar hits parity again. Jobless claims rose to 375,000 from 306,000. which was well above the expected 320,000. The Chicago PMI dropped to 51.5 from 56.4 in January versus the 52.0 that was expected. In the aftermath of the two Fed cuts, traders are now focused on today's employment reports. There is a debate whether the unemployment rate will remain unchanged at 5%, or actually fall to 4.9%, and some are even forecasting a 75,000 rise in payrolls. On another note, the European Central Bank remains concerned about inflation, hence the dollar's weakness may not be over. In November, the Canadian GDP growth eased to 1% from 2% in October, sending the loonie back to parity. Further supporting the pair was the Bank of Canada's Governor Dodge, implying that the Canadian economy will begin feeling the effects of the U.S. slowdown. Taking a closer look at the Asian session, they were in consolidation and seemed to be waiting for the U.S. non-farm payroll and ISM reports. The dollar was stable with a slightly bearish bias in the Asian session, as traders seemed content to wait for today's important U.S. data. The euro-dollar was stuck in a 148.46 to 148.74 range, while the dollar-yen had a choppy trade around 106.20 to 106.60. Asian equities were mixed and unable to take advantage of the unexpected U.S. rally of yesterday, where the S&P finished up at 1.7%. Precious metals moved higher, led by gold, which temporarily reached a new high at 936.61. It was a quiet day in both the UK and Europe in regards to economic data. In the US, the ISM and NFP reports have been hyped and are visibly anticipated. The ISM has been one of the most dependable indicators of near-term economic growth. The fourth quarter GDP growth dropping to 6% is the first reliable look on the perspective of the new year. The surprise December decline to 47.7, which was subsequently revised to 48.4, helped fuel market speculation that the U.S. is already in a recession. The collapse of the Philly Fed suggests further decline in the January ISM, but this is by no means written in stone. There is still significant evidence that points to a possible surprise to the upside. The employment reports this morning will play a critical part in the market's assessment of whether the U.S. is heading for a recession. A decline would provide plenty of support that economic activity is about to take a turn for the worse, as the labor market is a core component of the theory assessing the pertinence of a growing recession. Let's see how those numbers played out this morning. First of all, the non-farm payroll came in at a minus 17,000, way down from an expected 65,000 positive. On the other side of the coin, the ISM manufacturing index came in at a 50.7, which was up from an anticipated 47.3, and also the ISM manufacturing prices came in at 76.0, which was up from an anticipated 68.0. So on one hand, we have the non-farm payroll saying, not so good, the ISM saying, well, we're okay for right now. So I think we have to wait for our revised figures possibly on Monday to see exactly what is going on. Overall, the market was anticipating the weaker U.S. figures, which will add to an already bearish sentiment. They were saying that should the ISM or the NFP rebound, it would be a signal that the U.S. is not contracting as quickly as anticipated, which in turn could strengthen the argument that the recession is not inevitable. In the European session, they're saying the NFP falls off a cliff. Once again, the non-farm payroll provided the market with plenty of fireworks. As we mentioned before, the NFP came in at a surprisingly weak figure of minus 17,000 versus a 70,000, and that number was also revised from an 82,000 prior reading. While the reading in itself doesn't decisively say recession, the odds that the U.S. is slipping in that direction are favoring this scenario. Perhaps the Fed's aggressive 125 basis point cut over 8 days seemed to have been on the mark. After the ADP survey, the market had begun to speculate that the figures would be better than expected. Clearly, this was not the case. The market recognized that a major slowdown in the U.S. will have significant spillover effect in the UK. The pound dollar has been under pressure all day, but traded down to 197.64 on the U.S. release. The markets were eagerly anticipating the ISM and the University of Michigan surveys today, and they were also expecting another high volatile release. This concludes our news for today and for the week. January was certainly an interesting month, and we look forward to finding out what February brings us, and hope you will join us for that. We would like to invite you to visit our website at www.succeedinforex.com. There you can find a link to our Forex forum at Yahoo, which is also Succeed in Forex.